they're known as liquid alternatives, which is really just a fancy way of saying mutual funds and ETFs that mirror hedge fund strategies. Liquid alts have ballooned since the crisis as mom and pop investors sought access to fancy hedge fund strategies that were historically only open to high net worth individuals and institutional investors. But a new report by Morningstar finds that most liquid alt funds have failed to add value to traditional portfolios of stocks and bonds. Morningstar tested a variety of strategies, tactical allocation, long short equity, managed futures, etc., over a 5-year and 3-year time horizon. The firm found that the risk reward of liquid alts failed to improve a portfolio's efficiency. Historically, though, it was beneficial to have some kind of hedge fund exposure and add that to a traditional allocation of stocks and bonds, Morningstar found. But in the last 10 years, the benefits of using hedge fund strategies have basically vanished, as you can see from that chart there where the two lines merge. This is notable, though, because fees for liquid alternatives are typically much higher than your average mutual fund and ETF. And additionally, liquid alts haven't really been tested in a downturn, and there are concerns that when a downturn arises, they could be problematic. One such fund, managed by LJM, was short volatility and plunged when the VIX spiked in February, causing the fund to close. According to Morningstar, many of these liquid alt funds can do more harm than good, guys.
I know you have thoughts on that.
Okay, so liquid alts was a hot word, as you know, Leslie. Like 3 or 4 years ago, everyone said, liquid alts, like it was a Harry Potter novel, and all of a sudden something magical was going to happen if you just said the word liquid alts. It turns out it's just managed futures programs or long short hedge funds, and they don't work as well because indexing has won so much of this game. And this is it actually is the intersection of what you're talking about, the debate between indexers and people who go out and say, oh, I'm a lot smarter. Let me do managed futures, commodity trading, and I can do that. I won't comment on whether that's a great strategy long term, but the idea of diversification, and let's put 15% of our fund in liquid alts because, well, that's what we're told to do. I think that should be rethought a little bit.
There are also 40 Act funds, so they have restrictions on things like leverage that you wouldn't necessarily get the same type of return profile as you would the actual hedge fund that is really restricted to just qualified institutional investors. So it isn't exactly the same thing, but you're still paying pretty high fees for the product.
Wouldn't you agree, though, Leslie, that the idea that if you're going to an institution or you're going to a pension fund, they say, oh, well, we have to have 15% in alternative products because why? The investment committee suddenly decided that you're going to get superior returns.
Exactly.
It turns out you don't. That's the key point here.
And the fact that it doesn't always give you the diversification that you might be looking for. That's according to Morningstar.